Hi, it's Larry Gaines, and this is the Daily Aftermarket Outlook, and it's Tuesday afternoon, May the 9th. Well, let's take a look at the broad markets. Okay, so here, these are all daily charts, and if you look here at the NASDAQ 100, we've had this huge explosive move up, but very, very extended, so from the moving averages, so very extended from the 21, and that's kind of my mean moving average, okay? So very extended here, so you don't want to chase it up here. Now, the S&P is, back up to prior highs at 2,400 right here. And starting to stall out a little bit. You can see momentum, cycle 1 is pulling down. Now, here's the other key. You've got IWM, the Russell 2000. It's major divergence. See how the price is pulling back? Look at momentum. Cycle 1 is down below 0, and everything else is above. And then we've got the Dow starting to break the 8 exponential moving average. That's the first level of support. Next level is down here. So based on this, we're seeing some cracks in the strength of this market. Now, there are a lot of sectors that are still super strong, but we're seeing this, and so today we set up a bear call credit spread. We've been watching the SPX and did set up a bear call credit spread based on a potential for this market to start, either churning sideways, letting the moving averages catch up, or price pulling back into the moving averages. So let's take a look at that. So here's the S&P 500 cash SPX. You can see here's the prior high, 24. What is that prior high? 24. Right here, 2400.98. So today it popped up above it. But where did it settle? It closed right at 2396.92, and you can see it here. Okay, so a little bit of divergence from that Russell and the Dow, and you can see momentum starting to pull back here. Now the 4-hour time frame though is in a nice squeeze here, so it could trigger to the upside, and this is what would propel the market higher. So it is in a squeeze, but we'll watch this tomorrow. But based on this kind of patterns that I'm showing you, and seasonality tends to go a little bit more sideways, looking for a potential turn to the downside a little bit, or maybe just a turn sideways, we set up a bear call credit spread. So sold the May 26 series setup. Here was the setup. May 26 option series, so that's little less than 20 days out, and sold that the 24.20, 24.25 $5 wide spread at $1. So risking, based on this spread, 400 to make 100, so that's a 25% return. Now the reason to do this is a bear call credit spread. It's out of the money, and based on where it was sold, it's close to 1 standard deviation, which gives you a probability to the downside of about 80%. So if we come over here and we look at that May 26 series right here, and you can look over here at the option delta, put the delta in here, you'll see that the 24.20 series right here is got an option delta of 24. Okay, so 24, that can also be interpreted as a 24% chance that price can get to 24.20 within the next 17 days. So the other thing you can look at then is probability out of the money. So if you look at this 24.20 short strike that was sold, that gives you a 24% chance that it can get to 24.20. So that would be a 76.4% probability that it will stay out of the money, that this will be out of the money by 17 days. So you can see, so you've got the probabilities in your favor going into this trade, so that's why it's what we call a negative risk reward. Okay, so that's collecting $100 on a risk of 400, but you've got almost an 80% chance that this price will close below 24.20. Now, you always have to have a defensive plan. So if this was to, my line of defense is if tomorrow or whichever any day this was to start pushing above 24.05 strike, then I'm going to look to convert this to a butterfly, and what I'll do is then I'll buy the 24.15 right down here, 24.20, same expiration, May 26, wherever that might be. So that went out today at $1.40. If I did that with my dollar credit, then my risk is totally neutralized and reduced down to just $40 either side versus the $400 from the credit spread. Okay, so that's the defense. So that's the SPX bear call credit spread. Now we did another couple different trades here today, and I'll show you those. Now still have long the ratio put butterfly for expiration Friday. And this trade still is got some nice profit locked into it. And here's what that looks like. Took some off yesterday and for a $105 profit per spread, and still have some left to see where we can go out on this Friday. So this was selling the, or this is the put ratio butterfly, and here's the setup. It was buying the 152.5, selling the 150, and then selling the 150, buying the 148. Put ratio butterfly 1 by 3 by 2. Did that for 70-cent credit. Took some profit yesterday at 35, so that's $105. Went out today at 30 cents debit. So today, it still has about $100 profit per spread. Now, if it can pull back into this area into Friday to 150, this thing has a chance to make some really big money. So that's the Apple ratio butterfly for expiration this Friday. Now, I jumped into Tesla today. We were watching this yesterday. Was scratching my head whether or not to buy it yesterday, but decided to wait one more day to see if it pulled back anymore. Well, it pulled back a little bit, tiny bit. You can see where it opened up here. It opened up strong and never really looked back, so we just jumped into the trade. So here's what it looked like coming into Tuesday morning. It opened up right in here, and then just really started to pop to the upside. So before it really took off right in this level here, about 314.5, picked up and did the 317.5. So bought the 317.5 right here. Sold the 322.5 call debit spread. So really nice. Looking for a target too. We were just looking for the first target here at 320. So very explosive move, and that's typical of Tesla. So we were looking for the first target right here, that 786 retracement at 320, and got that and more. So did take some profit here today. So this was put on today, took some good profit here today. Looking for this to extend back up to potentially 326 prior high, and then the next target would be 336. So did this trade set up for expiration this Friday again. So bought the, let me change this over. So a couple of the members did it as a ratio butterfly, and a bunch of us did it as the setup as just a debit spread. So jumped into the 317.5, 322, $5 wide spread, May 12 series, expiration Friday, $1.60, 160 at risk. Max profit at Friday expiration would be 340. Went out today at 275, so it's up $115 right now. Max potential profit though again is 340. Took some off at 265, so made $105 per spread today. Just put it on today, took off some today, still looks good. So that was Tesla. And then yesterday we set up this swing trade on Palo Alto networks, and so bought here. Let me blow this up so you can see that it was really turning the corner. You can see how it blew through this prior high, and then yesterday it was looking to push into this 1272. So went ahead and set this up yesterday and did a very defined risk trade again. Did the 117, so bought the 117 right at the money yesterday, 117 right in here, and then sold the 120 above right here. Okay, so did that, had a nice pop today, took a little profit off of that, but we'll keep the remainder. So this was for next week's expiration, not this week. If we'd done it for this week, it'd be very, very profitable, but set it up for the monthly, and here's what that looks like currently. Did take a little bit because we started hitting those targets, so it took a little bit off. So set up the 117, 120, May 19 series, debit spread, 115, took a little 145, went out there at about 150 today. So 145, 150, so a little bit of profit there. If we can get a bigger push, this has potential for some pretty good profit as well. So that's Palo Alto. Then we did a broken wing butterfly on AVGO. Okay, so this one looks for potential to move up to this 1272 extension up here at 232. So we set up a broken wing butterfly so it has very little downside risk. So right here you can see this swing high to low. Let me pull this back up. Okay, so see that high to low. So then this gives us our next fib target up here to 232. It's broken that area here, so set up a butterfly, but did it with a broken wing to reduce the cost. So let me show you that. So here's the difference. If we'd done a straight butterfly, the 230, 232 and a half, 235, that would have cost $45. So if the market craters, goes back down, you'd lose $45. But we did a skip strike to reduce that cost. So basically here's the deal on that. So by skipping one strike on the long call, on this long call here, instead of doing the, instead of doing this, buying the 235 call, so what we did was bought the 230, sold the 232 and a half call, right? And then instead of buying the 235, we skipped one strike, bought the 237 and a half, which made it cheaper. So got into that trade at $15 or 15 cents. Now that increases your risk if it blows to the upside, but if the market, since the markets are so extended, kind of wanted to reduce the risk more to the downside, so the risk is 15, but to potentially make big profit over 200. Okay, so that's a broken wing butterfly for May 19 series, monthly expiration on AVGO. Still have a short trade set up here on ADP. The thing was, when we set this up yesterday, we knew this was major support at the 200-day moving average. So we knew the risk. So if it holds here, this could be where it holds and bounces back up, but did a pretty defined risk trade. So bought a 95.90 put spread for the May 19 series monthly and did that at 50 cents. It went out today at about 30, so this is down about 20 cents, but you can see it went out pretty weak here into the close. So we'll see how it goes tomorrow. So it actually, let's see here. Actually, got a bounce here today. So we'll watch this. If it gets down to, my stop loss will be probably, if it gets down to 20-cent debit, so I would stop out, lose 30 cents. So that's ADP. So taking a look at oil, I think oil is going to stay under pressure for a little bit longer. I think it's going to come back down here and retest this prior low. We'll see tomorrow. Tomorrow oil inventories, but I'm not really doing anything right now on oil. I'd be looking, if we break this 45, I'll look to pick up some UCO put spreads. So right here at 45, be watching that tomorrow. And the trade setup would be looking to buy UCO just as kind of an intraday day trade, or maybe a little, not too much, just a very short duration trade. So if it starts breaking this area tomorrow at 15, I'll pick up some $15 puts on UCO for probably this week's expiration and see how that goes. So that's on my playbook for tomorrow. And then we did a earnings trade setup on NVDA. So a number of the members caught it. I did not get the execution to fill, but it turned out to be a great trade. So let me show you. So we set up an iron condor debit spread, just looking for a move for 3% move up or 3% move down, and the expected move was for an 8% move up. So let me show you what that looked like. So we set this trade up looking for, the expected move was for it to go up to 107 or down to 100. So it closed at 102.92. So set up a trade. Actually the expected move was to go up to 111 or down to 95. And so what we did was set up a trade for just a 3% move up. So 105, 107 call spread, 3% move up would be close over 107, or a 102, 100 put debit spread for move to 3% to close below 100. Now, the earnings came out and it had an explosive move to the upside. So you can see the initial post-earnings move here was, let me see here, the initial move was up 2 standard deviations. So the expected move was for $8 up 111, 8% basically, and it moved up to almost 2 standard deviations. So we'll see what happens tomorrow in the open, but right now it looks real good, and a number of members did get this on at $1.60 debit, so they have potential for a $40 profit if it closes over 107, which would be $40, and the risk is 160. So that's what is that? 40 divided by 160, about a 25% return. But a nice, looks really good, 25% return. So here's that trade structure, and missed out on that. So here was the structure was buying the 105, 107, 102, 100. So it's just what we call an iron condor debit spread, cost of 160. So the risk is 160 to make 40. If it closes at close Friday at over 107, you make $40. If it closed below 100, you would make 40. That's 25% return, and that's based on the earnings statistics for NVIDIA, which tends to have pretty explosive moves. So let me show you what that looks like. So here you can see NVIDIA down below. See 3 days. This would be like into a Friday expiration. So last earnings season, it was down 2.37%, but before that it was up 29, up almost 6, up 15, up 10, 13, 12, down 7, up 7. So by setting it at a 3% move up or down, it has the last 10 cycles it's had 8 winning trades based on that, and these were very small losers, because if you set it 3%, you're going to lose, probably a little bit less than 1%. So anyway, that was the structure, and that was the setup. So I hope this helps, and I'll talk to you on the next update.